There is so much going on in this market right now. Today we got big news that the very large international bank Credit Suisse might be on the brink of collapse. However, I think it's important that we do some more digging into this story and also cover this new news that they're going to be borrowing $50 billion from Swiss National Bank. But before we get into all of that, this is the weekly report, and I usually cover a lot of different topics in the market, what I'm looking at right now. And so I definitely also want to be talking about what's going on with energy, what's going on with bonds, and what I think the Fed's going to do next due to what we're seeing being priced into the bond market. And if this video doesn't satiate your hunger for information, remember there's always tons of it in the Discord. So make sure you join there and you can talk to all the other traders. Now, I'll be honest, my brain's getting a little bit tired. This report's probably going to be short, but I am going to do a quick spark notes on everything that's been going on with the banks. Now, remember, I did a full report on this, so if you haven't seen that video, definitely go check that out because it still holds up today. But let's also cover what's been going on with the banks. Now, a bank run is when many people all at the same time try to withdraw their money from the banks. Now, what the banks do with your money is they take that and they use it to buy treasury bonds, which are considered really safe, right? But with the Fed rapidly raising interest rates, banks are actually currently underwater on their treasury holdings, which really isn't a big deal. You give them time, they're safe investments, you'll make that money back so long as you're able to hold those bonds to their maturity. So this fear that banks will collapse is actually becoming a self-fulfilling prophecy because banks are having to sell these underwater holdings, taking massive losses and running into liquidity issues because everyone's withdrawing. If everyone wasn't panicking out of their positions within these banks would actually be functioning just fine. And so when we look at Credit Suisse and what's going on right there, it's important to note that this bank has had tons of warnings about them having awful risk management and being at risk of collapse. In fact, we've been hearing about them being on the verge of collapse for many years. Now, this was new to me, actually. When I first saw this, I thought it was a huge deal. I started talking and networking with other traders saying, hey, what do you think about this? A lot of the older traders were saying, yeah, I've been hearing about this bank potentially collapsing my entire career. So then I just started to do my own digging. Now, we actually asked ChatGPT. Now, remember, their database goes all the way back to 2000, right? So I asked ChatGPT, since 2000, how many articles have come out talking about Swiss Bank actually having a collapse? And there's been 500 news reports in the last 23 years. So I asked it, okay, what are the 10 top years? And it's 2010 through 2020, a decade, the past decade, basically, there's been nonstop reports of how big of an issue this bank was. The point is that none of this is actually that new. We've heard about this many times before. This bank has, surprisingly, continued to be sturdy despite these continuing reports that they are on the brink of collapse. And I don't think that these reports are just in the past 20 years, especially from the way some people are reacting from me speaking to them. Now, this dates my experience, so it's important that I network and talk to people about this. And I think this is one of the great reasons that having a Discord is like so beneficial, because having more opinions means we can be more accurate. So what I'm trying to say is that this does not look like an actual likely outcome, especially when you dig into what's going on with Credit Suisse, especially when we look at the news report that, hey, they are getting a massive loan from a Swiss bank that, $50 billion to help them get provided with some liquidity. But, and this is a big but, I'm talking Cardi B sized but, these bank runs can become self-fulfilling prophecies. So Credit Suisse might just be the beginning of more banks having continued collapses, and we could be far from the end of this blow up. That said, as of this moment, and I literally mean this exact moment because this is changing day over day, right now, everything the Fed's doing seems to be providing a nice backstop to not have this turn into a massive contagion event. And it seems like that it is effectively providing some security to depositors and keeping them from continuing to do withdrawals from some of these banks. Now, a few banks, such as the First Republic Bank or obviously Silicon Valley Bank, they're already screwed. Silicon Valley's already gone under, and they're going to likely be getting it bought out. And then there's rumors that Goldman Sachs actually gave them bad advice that led to this blow up because Goldman wanted to buy them out. So there's also some things in the background. Looks like some dirty business, some underhandedness. But that's all the past now. We're dealing with what's happening in front of us. And what's in front of me right now is bond yields. The bond market is pricing in multiple rate cuts before the end of the year. And I don't think that that is the Fed's plan at all. In fact, the rumor is that we still get a 25 basis point hike. Now, I think that would be pretty surprising. However, the people saying this have been really accurate. So this is like the rumor on Wall Street right now, is that we're still going to get a hike and that Powell's going to want to get the market caught up with what he thinks we should be doing to combat inflation. Because remember, even though inflation seems under control, it's not coming in at expectations, it's still high. So if we now take a moment to actually cut, the probability that that comes back in a big way is really, really, really high. And we're also coming into an election year where both political parties are likely going to want to print more money, providing more stimulus, which makes the probability of this inflation story getting out of control once again over the next few years exceptionally just like very probable. So I think that the Fed at the minimum will want to pause, and I think that the bond markets need to take this into consideration again. I think some of the markets are getting ahead of themselves way too rapidly, saying, okay, we're going to go back to easy money. All this is going to get reversed because they have to do it. And I just think that they're little kids looking for the candy of free money, and I don't think it's actually going to come. So what does this actually mean for the market? Well, if we look at the S&P index, we can see that the last time we had the TTM squeeze starting to roll over like this, we got a pretty stark rally. And if we're thinking about what could cause a rally right now, it's that all these bank fears really blow over. We get some normalization, some more factors filled in. Maybe we see this volatility drop down some. If we're looking at the VIX right now, I mean, we're at a 26 VIX. It's not almost at 30 where it was just a few days ago, but it's still really high. It's still at a territory where you would say the bears are in control. However, I think that a rally wouldn't be too surprising. And so to support this more bullish case that I think is developing, due to the fact that I also see that Bitcoin looks like it has the potential to go on a massive third wave rally, which would make me think that the broader market environment will also get more liquidity, become more bullish, have more of a risk on factor. I've been recharting SPY as well to try and make sense of what's been going on. So this would lead to a wave 1 development right here, wave 2 already completed, and then wave 3, which has the potential to take us to 460. And it's kind of one of those shrugging moments of, does it make the most sense? No, I think that if this is what plays out, it could be the potential of the Fed has actually landed the market safely due to the fact that these banks got them to quit cutting. I think if the banks actually hadn't had these issues, the Fed would have just kept doing it until they crashed the whole market. However, this warning signal was one that they were actually able to fix and might actually lead them to pause, in which case that they might have genuinely safely, not very safely, there's a bunch of issues right now, but safely landed the market. And if we continue with that narrative, now remember, this is all very speculative, very likely to change over the next few weeks or over the rest of the month. Remember, I put these out weekly. On a weekly basis, this might change. The success that I have in the markets is from being able to pivot quickly. All right. Darwinism is not the strongest or the smartest that survive, because I'm neither of those things. Okay. It is the most nimble. I can do that. I can be nimble, and I can be willing to change when I see that the facts have aligned. So if we do get the recession that I still think will happen, I still think we're going to have a severe, quick recession. There's some people who think the recession's already happened. I've teetered almost over to that camp at times, been really doubtful of my position on that stance, not my position in my account. Account's been great. We've been having great success in Discord, but like on my narrative that I have, I've had some teetering, but I still think that we have it coming up, and that could be the fourth wave down on the realization that the economy is having a pretty severe pullback, especially with the interest rates high still. And then a fifth wave when the market inevitably prices the recession in before the economy does. And then we get this fifth wave rally up where we climb a mountain of worries where everyone's saying, well, this is awful, everything's terrible, but the market keeps going up anyways into 2024, which is an election year, which is historically good for the market. So that's the thesis right now. And if you want more information on that, I did a big write-up on the Discord. You can ask me questions about it there. Now let's talk about energy. That did not used to squeak like that. Energy has continued to be a pain in my butt. If you're in the Discord and you've been keeping track of my trades, you've noticed that I've quit trading energy a while ago, and I don't plan on returning. Now, when it comes to my long-term account, I still have some positions when it comes to uranium, which I'm probably not going to sell for the next 5 years. But I also have a natural gas position, and I did cut USO. So natural gas, I am looking for an exit. It's either going to force me out an emergency exit on a break of $8, or I'm going to find one if we actually do manage to reach 12, which I don't think is necessarily as highly probable as it was just a few weeks ago before all these issues in the market. When the market gets in tantrums like this, it all starts to sell off. Everything just sells off completely. You know, whatever technicals you had, yeah, game over for those, because the fundamentals of that crash will outweigh that anyway. So what I'm looking at when I'm seeing energy is that even though the fundamental bullish case is still there, it's still alive. I still believe it. I still have convictions there. I think I need to give these room to breathe, because the price action is just going to fight with you all the way. So even if you have heavy convictions, you can't let that outweigh the price action. I often use the analogy of surfing rather than sculpting. Okay, ride the waves. Don't take your framework and sculpt it out in the market, because the market's just going to run you over. It doesn't care at all what you think. And so that's been my interpretation of how to handle energy right now. Just thought I'd give an update on that, because I don't think I've talked about the last two reports, just because it hasn't been a big trade for me, even though I still have positions when it comes to uranium and natural gas. Now, at some point, I will be doing some more buying on uranium, probably talk about that in the future. I still have huge bullish cases there. I still think it'd probably be one of my best trades over the next 5 years. I still think it's a big one. But for now, just going to let these breathe. And that's going to be it for this week's report. I'll see you on the next one.